Good morning, everybody. I hope everybody can see and hear me properly. As we wait for our colleagues to join us, we had the idea of us introducing ourselves so that as soon as they join us, we can then kick off. So basically, by way of introduction, my name is David Owiro. I'm a consultant. I'm here under the brief of Okoa Uchumi. I provided some support for them in the past by way of alphabetic order. So please, Angela, go ahead and introduce yourself.
Good morning, everybody. Angela Wangeshi. I work with TISA. Yes, and I'll be co-hosting this forum. Thank you.
Yes, and just a slight housekeeping, because I'm seeing we are also live on Facebook. I think in addition to our audio, perhaps we can also do video where you can as well. Thank you. The next person is Andrew.
Yes, good morning, everyone. My name is Andrew Gogo from Oxfam in Kenya.
All right, thank you, Andrew. Next on my list is Christine, who already spoke to us. Christine, please go ahead.
Good morning. My name is Christine Akenyi from TISA.
All right, thank you. Elizabeth. Elizabeth, if you can hear us. We can go to Eunice. Seems Elizabeth is a bit, Eunice, go ahead.
Good morning, everyone. My name is Eunice Kamau from Inuka Kenyan Limited. Thank you.
All right, thank you. I'll invite Imali.
Thank you very much. Hello and good morning, everyone. My name is Imali Ngusale and I currently work for DSW. I must apologize, my bandwidth is not too reliable, so I'm going to keep the video off now, but when it becomes better, if it's enhanced, then I'll put on my video. Thank you very much, and over back to you, David. Thanks.
Thank you for that, Imali. I'll now invite Judith.
Good morning, everyone. My name is Judith Chepkemoi. I work for Center for Social Planning and Administrative Development, CESPAD. Thank you.
Thank you so much. I'll invite Riva. I've seen Jason has entered, but I'll give him some time to cool off his heels as we continue with the introductions. So please.
Yep. Good morning, everyone. This is Riva Halipa with Oxfam in Kenya as a tax justice strategist. Thank you.
Thank you, Riva. I'll invite now Rose. Rose Ngugi, if you can hear us.
Hello?
Yes, go ahead now.
Yeah, my name is Rose Ngugi from the Kenya Institute for Public Policy Research and Analysis.
All right, fantastic. So because we have with us Jason as well as Shiro, I'd like to invite Shiro to make her brief remarks and then invite Jason as well. So I'll hand over at this point to Shiro. Thank you.
Thank you so much, David, and welcome to all those who have joined us. I think, David, there are a number of people who joined as you are making the introductions. And so once Jason and I have made our introductions, you might give them a chance so that we can know each other. It's a small meeting, or rather it's a small number on this call. So I'm Wanjiro Gekonyo, the National Coordinator with the Institute for Social Accountability. TISA also coordinates the Okoa Uchumi Coalition. And the Okoa Uchumi Coalition is an informal coalition, a grouping of civil society organizations that came together in late 2019 because we were concerned about what we call the debt crisis. This is still a matter of argument. Government insists that the debt is sustainable, and we say, yes, it may be sustainable, but the impacts on the economy and on service delivery as far back as 2019 definitely points towards a lack of sustainability and a crisis. So we frame Kenya's debt situation as a crisis because of the impact it's having on various sectors and our ability to deliver services alongside servicing this debt. And the coalition is also concerned about governance issues concerning debt and the impact, the lack of governance and the lack of adherence to PFM requirements has aggravated the debt issue and continues to impact upon us today. So I'm happy to be here, and today we are happy to partner with AFRODAD, who requested us to co-host this event to understand more or to hear more about special drawing rights and how this can be used by countries to strengthen their COVID response and to mitigate against the worst effects of you know, the debt crisis or the debt burden. So today we'll be hearing from AFRODAD, we'll be hearing from their partners with regard to special drawing rights and some of the recommendations they are making around this. I will also have an opportunity to speak in a little bit around some of the concerns that we would like to see addressed as we consider this initiative, because the thrust of the Okoa Uchumi campaign is that political accountability is the starting point for an effective COVID response. Political accountability is the starting point for effective debt mitigation and resolution. And we shouldn't allow ourselves to get caught up in the technical discussions and conversations and lose sight of the fact that lack of political accountability has played a major part in bringing us to the present crisis. And so any solution coming from civil society has to be underpinned, underscored, and built around the issue of political accountability and transparency. I'll leave it there. I'll ask that as partners make their contributions, they are free to, just speak to their role in the Okoa Coalition as they feel, because we have a number of members who are very actively involved, and we're always seeking to include others to support the initiative. I think, David, I'll leave it there for now, and I look forward to sharing a few more of my thoughts and those that we've crafted with the coalition in a few minutes. Thank you.
Thank you so much, Shiro. I take note of the additional participants who are coming in, but at this point, let me invite our colleagues from AFRODAD. I've seen Jason, I've also seen Fidelite. I don't know whether I'm pronouncing it correctly. So I'll invite at this point Jason to also do his introductory remarks before we embark on the program. Welcome, Jason.
Great. Thank you, David, and nice to see you after such a long time. Good morning, colleagues, comrades, and distinguished participants. Thank you for making time very early on this Monday morning to join us to discuss what is a very growing and urgent issue around the debt crisis in Kenya, but also more widely across the continent, and the different options that civil society organizations are considering as we advocate for a combination of debt relief, suspension, restructuring, and cancellation. My name is Jason Braganza, and I'm the Executive Director with the African Forum and Network on Debt and Development, also known as AFRODAD. It is a great pleasure to be partnering with the Okoa Uchumi Coalition and specifically with the Institute for Social Accountability, 10, and her team today to bring this conversation to a more granular level and a more national level, where we try and internalize what exactly the special drawing rights conversation taking place at the global level, at the International Monetary Fund level, actually means for our country here in Kenya. And specifically, why does it matter in terms of it being one of several options of debt relief and suspension and restructuring and cancellation that civil society organizations at the continental and global level are advocating for with regard to the debt crisis. Just to put a little bit of context onto this conversation, the debt crisis that the continent and Kenya specifically is facing is one that has been accelerated by COVID-19 and the economic and social effects that the pandemic has brought with it. This is not to say that we had not predicted that this was going to happen. It's just that it has come a lot faster and a lot deeper in the way it has overcome and overwhelmed a lot of our economies and our societies. The reports from institutions like the African Development Bank, the African Union, the United Nations Economic Commission for Africa, at the continental level and then at the global level, the World Bank and IMF are all predicting quite a period of doom and gloom for the continent with regard to economic development, with regard to economic growth. And in fact, in some cases, are predicting a reversal of fortunes on many of the social indicators that have, over the past 10 or 15 years, moved in such a positive direction. There's some estimates that extreme poverty on the continent is likely to increase by 2.5% over the next 12 to 18 months. The loss to GDP on the continent due to lockdowns and reduced schooling and education is estimated to be around $500 billion to the continental's GDP. So you can see that the debt crisis is one that is having a severe economic and social impact on the continent, and nonetheless, more specifically here in Kenya, the same is also true. And when we talk about the interventions that we are looking to advocate for at national and global level, all of these are foundationed around the issues of transparency, accountability, and governance between the interactions of debtors, that is countries like Kenya and many countries across the continent, and creditors. And this is where the definition has really changed over the past 15 years. You know, we've gone from having bilateral country creditors, so our, what we call our traditional development partners. We've also had the international financial institutions, but then increasingly we've had the introduction or the coming in of commercial private creditors and also non-traditional lenders that have added to the pool of creditors that countries like Kenya have access to. And in all of this proliferation, the ability to negotiate and hold steadfast the sovereignty of the state in these negotiations has been a bit of a challenge. And so you do find situations where the governments tend to be a little bit more liberal in how they sign on to these loan contraction agreements, and the lack of participation amongst the citizens in these processes. And then finally, the lack of a legal framework. And so this is how we've come to be in a situation where the loans and debt that we've accumulated over the past several years become problematic when we have a crisis of this kind of the global pandemic. And so now what we're trying to do is look at the different options that are available to developing countries to negotiate suspensions and relief. So, many of you would have heard of the Debt Service Suspension Initiative, which has been, which right now we're advocating for it to be extended beyond 12 months to 24 months. Many of you would have heard of the G20 Common Framework on the Treatment of Debt, which is, while the most advanced initiative, it still neglects the inclusion of our private creditors, and it also neglects the inclusion of the international financial institutions, namely the IMF, the World Bank, the African Development Bank, and so on. And then now we have the conversation around the special drawing rights. And this is the special currency that the International Monetary Fund uses to quantify how much support and how much access to the reserve that different countries can have. The special drawing rights is a currency reserve that is accessible to all member countries. However, it's not accessible on an equal footing. It's accessible only based on your voting rights or your capital rights in the fund. And this usually means that it is biased against developing countries. And so in the conversation around special drawing rights today, in the context of Kenya, what we're looking to have a discussion around is, you know, its value in terms of being an important option, policy option for Kenyan officials to consider, its efficacy with regard to citizens understanding what the impact is likely to be if the special drawing rights amount, which at the moment is around $690 billion that's being negotiated, if that, what does it actually mean for the taxation system, for example, in Kenya, if it is taken on board? What does it mean for citizens, not just in the immediate term, but also in the medium to long term with regards to, as we know with IMF, it's usually, there's a lot of austerity that comes with it and cuts in social spending. So as citizens, we need to understand its efficacy as a policy instrument. And thirdly, we need to appreciate that the special drawing rights conversation is not a silver bullet. It's an option in a menu of options available to developing countries. It doesn't fundamentally address the structural issues around the debt crisis or the debt composition of many of our countries, including Kenya. And I think Wanjiru alluded to some of this, and she will, I'm sure, in her presentation. And also, it's one that does not address how the global debt architecture functions. So it's important to understand that as we go about having this conversation around special drawing rights, that we are not hailing it as the silver bullet to the problems that the continent is facing and Kenya specifically is facing, but we are saying that it should be on the menu. It should be an option that countries can consider in trying to access immediate liquidity in order to address the immediate challenges of the COVID-19 pandemic. And so in that regard, it's my hope that, you know, over the next hour and a half or so during this conversation, we will be able to unpack a lot of the technicalities around this, but also start thinking about, you know, how we craft our advocacy messages, both with government here in Kenya, but also with the IMF, you know, both here in Kenya, but also in Washington ahead of the spring meetings. And this conversation today with the Okoa Uchumi Coalition is one of several meetings that AFRODAD is holding across the continent to galvanize, number one, understanding around the issue of special drawing rights, and secondly, an advocacy position around the issue of the different debt relief options and eventual debt cancellation that we will be advocating for as the days go on. But it's also to bring together the experiences from different parts of the continent, which, whilst different in some ways, in a number of ways, they're still the same in terms of the homogeneity of the crisis. So it's with those reflections and with those intentions that we have partnered with several organizations across the continent, and today we're in Kenya to talk about the Kenyan context and how we take this forward. And so I realize I may have gone over my time, David, but I thought that might be a useful just context of why we're having the conversation today and where it's likely to feed in. Thank you so much.
Fantastic, Jason. I think I allowed you to go on because some of the remarks actually are what we are going to speak about. And already you do raise some very pertinent questions that Okoa Uchumi here in Kenya has been raising around transparency, around the legal framework, and also around the questions around public participation. So I think that's quite useful. So thank you very much for that. And we also welcome this opportunity as stakeholders to learn more about the special drawing rights as one of the options of dealing with the pandemic responses, as well as the broader debt questions that we've been raising. So I want to take a slight pause at this moment to allow for those of us who had not introduced themselves to do so. Basically tell us your name and the organization you work for, and of course, your participation within Okoa Uchumi, if possible. But I'd like you to keep it very brief, only for those who had not spoken before. Right, so I remember Elizabeth Ombasa. We can begin with you, and then we go to Trivangani Mutazo. As well as if you had not been introduced, just go ahead and introduce yourself. It's at this point, a free reign for anybody.
Good morning, David. My name is Elizabeth Ombasa. I'm representing Westminster Foundation for Democracy.
Thank you so much, Elizabeth. Who is next?
Good morning. My name is Abraham Ochil from the International Budget Partnership, Kenya.
Thank you, Abraham.
Yes, good morning, colleagues. My name is Tiriwangani Mutazu. I'm with AFRODAD in the Debt Department. I work with Fidelity and Jason. Thank you.
Thank you. Thank you so much, Mutazu. Next.
Good morning. Since my name has just been mentioned, I am Fidelity Shimimana. I work for the African Forum on Debt and Development. African Forum and Network on Debt and Development. Thank you for being with us today.
Thank you so much, Fidelity.
Hi, David.
Hello, Jane.
Hello, hi. My name is Jane Mohia. I work with the Kenya section of the International Commission of Jurists on economic governance. Thank you.
Thank you so much, Jane. Who's next? I'm seeing Winnie Nkatha as well as Ndungu Wainaina. Okay, perhaps the connection is not so clear, so we'll allow them as they give their interjections or contributions as we go ahead. So thank you so much for both Shiro as well as Jason for giving that good introduction, and to Jason for somewhat already beginning to highlight for us what are some of the wider context questions that we are interested in. And so now I'd like to invite Shiro to come in and give us some of these big political questions that we've been thinking about here within Okoa Uchumi, as well as to sort of contextualize for us what are some of the broader issues that we need to talk about when looking at the debt question. So I'd like to welcome Shiro. Please go ahead.
Thank you so much, David, and thank you, Jason, for that excellent backdrop. The big question today is about the special drawing rights. And it's interesting, you put in one of your remarks was that the SDR is not the silver bullet. And in fact, that was my question, the question to my remark. So you've kind of preempted me quite seriously, because my question was, is Kenya's debt really sustainable? And then is the SDR the silver bullet? And as I said, the reason as Okoa Uchumi we keep stressing on the issue of debt sustainability is because we have a difference of interpretation between our assessment of the situation and that of the international financial lenders and institutions such as the IMF and the World Bank. And on the books, it's possible to argue that Kenya's debt is sustainable, but the indicators show otherwise, and especially as developments with an eye on development and with an eye on development priorities, we then see a different scenario, because we ask the question of where has the debt money gone, and how sustainable are those investments, and what are the returns coming from those investments, and what's the accountability of that spending. And so, the question of sustainability, I believe, is one we need to open up and move beyond the financial indicators, which mask the political context and the governance context, and may allow international financial institutions to come to decisions that actually will have long-term ravaging impact on the local budget and local communities. So my starting point on this reflection is to say that Kenya's debt has increased, has grown over the past 10 years, driven by local infrastructure development priorities of the present administration. And the idea that African countries need to invest in large infrastructure is the first bone of contention in our campaign, where we are saying we really need to debunk the idea that Africa's growth, that the main obstacles to Africa's growth is the lack of large infrastructure development. It could be there's a huge gap in infrastructure development, but what kind of infrastructure developments does the continent need, and do countries like Kenya's need? In our case, we have seen large infrastructure developments that have directly negatively impacted our devolved system of governance. For instance, health financing priorities, agricultural financing priorities that do not respond or accord with our devolved and decentralized framework, where modular type of investments that are smaller in size, more moderated in size, would be more prudent. We find large infrastructure with large rent-seeking opportunities taking the day. And the first problem we've diagnosed is this infrastructure-led development, when coupled with budgeted corruption, leads to, has led us into, really almost exponential growth in debt in the country. So the first indicator of the problem, of course, is always on the debt indicators. And we note that just this month, Kenya's debt rating was downgraded a second time since the outbreak of the pandemic. So obviously we are doing poorly on the international debt indicators, and this has resulted in a downgrading of our credit rating. Now, part of the argument, and in fact, Jason, the concept note as shared seems to imply that this problem, the fiscal pressure the country is facing, is due to the COVID pandemic. And so the second significant point I want to make is that Kenya's fiscal pressures precede the COVID crisis. And the crisis has simply amplified the extent of the problem. So we see a situation where our external debt and service repayment grew 11-fold between 2011 to 2019. So even before the pandemic, we were facing a huge external and domestic debt repayment burden. And as of 2019, our export to debt service ratio was at 60.1%. and had breached the IMF threshold, almost 3 times in 2019. Of course, with the onset of COVID and the restrictions around it, our exports have been negatively affected, but our debt repayments have continued, the pressure continues. So we then see a situation where, of course, these indicators have worsened dramatically. The next point we need to consider is that the external debt service was already eating into service spending prior to the onset of the pandemic. So major service sectors have had stagnant or declining budget allocations. And in Kenya, we have a very creative budgeting process that has been much abused by Parliament, whereby budgets are passed and then immediately revised. So they are passed to get through the constitutional thresholds of the allocations to various sectors and allocations to recurrent spending and such. And once they are passed, then Parliament proceeds to enact or pass supplementary budgets, which are not, unfortunately, due to loopholes in our budget system, subject to the same kind of scrutiny as the main budget is. So in essence, we are dealing with a situation where we have paper budgets that on paper look okay and reasonably balanced, but then the supplementary budget comes and distorts that. And the pressure here is the debt repayments. And so we see that this is the situation we were facing in 2019 coming into the pandemic. And like I said, this has only been aggravated by the impacts of the pandemic. Related to this issue and really this constricted fiscal space, the other problem we have that we need to consider as we are looking at the SDRs as an option, as a debt financing option, is that Kenya's budget is based on unrealistic revenue projections. And whereas we've seen revenues falling over the past 5 years, government has continued to present very rosy revenue projections and then make, continue to make all kinds, make it, based on these revenue projections, then present a macroeconomic situation that's really not borne out by the reality at the fiscal level. The reality is that revenues have been falling, and the shortfall has been augmented by more borrowing and by increased taxation. Some of this borrowing, a lot of it has been in the domestic market, and domestic borrowing has negatively impacted business, squeezing out businesses from domestic borrowing, which has then aggravated the fall in revenue because businesses have not had the capital they need to be able to perform as they can. So we've been in a spin, in a debt trap, and also in this kind of fiscal trap where heavy debt repayments, heavy domestic borrowing is pushing out business, is suppressing revenues, is increasing taxation. And this cycle has continued and been aggravated during the COVID period. So as we think of the SDR, we need to say, well, is the SDR really going to solve this kind of more systemic problem that we have? And as civil society, how do we ensure that any discussion about additional, accessing the SDR, how do we ensure it deals with the reality and is based on realistic fiscal projections and not the situation we have at present? Another major consideration that we need to address is that there's a disconnect between the IMF conditionalities and the our treasury's debt restructuring priorities. There is a major disconnect. The Treasury has all along proposed that to restructure Kenya's debt, we need to access more concessional borrowing, that's agreed, to retire more expensive commercial debt and also the more expensive domestic debt, and look for more affordable forms of debt, some of which are concessional, others of which are commercial, based on the extent that government will still be eligible for that. And the reason for this is because Kenya rebased the economy and is now considered a lower middle income country, and therefore has limited access to concessional financing. So we are in a trap of our own, kind of growth outlook. And the IMF is, part of the conditionalities is that Kenya will not go for more external borrowing because of our weakening exchange rate. Of course, it's very risky to go for concessional, external commercial borrowing. But then locally, Parliament is very alive to the reality that domestic borrowing is very inimical to the local business environment. This issue has not been put on the table and discussed. And we've seen a capitulation by the Treasury in terms of acceding to the IMF's conditions. But we are saying this cannot be glossed over, because borrowing will not solve, we can't borrow ourselves out of this problem. The priority the country has is to stimulate the economy. And part of that is to ensure that business is safeguarded, and that the debt restructuring process must prioritize the impact on the local taxpayer and local business environment. And the IMF's remedies in regard to those two is totally off the mark. And linked to this is the issue of taxation, and especially consumer tax, which the IMF favors. We've seen, and actually at present, we're in the throes of really a consumer outrage with regard to recently enacted increased fuel tax, fuel increase, driven a lot by the tax increases that have been as a result, or partly a result, or largely a result of these conditionalities. And we see that the IMF has continually favored the implementation of wide-based consumer taxes, which are very easy to collect, ignoring more politically sensitive but more systemic issues like dealing with concessions, which are massive and are a massive drain to our revenue, our coffers. So the issue of the IMF and its conditionalities is directly opposed to Kenya's, the Ministry of Finance's own diagnosis and our own diagnosis of the remedies that we need to implement to deal with the debt resolution sustainably. So in that regard, I think we need to exercise a lot of caution. The last point I'll make is the issue of transparency, or the lack thereof, or the inadequate transparency. Government and the IMF has noted this. There's debt that is not yet declared on the books. There are contingent liabilities of which we are not fully aware. And some of this debt to our mind is odious. And whereas the IMF did call for an audit of debt, the debt register, so to speak, this is not something they are likely to put center stage. So for us to bring in the SDR in a situation where we've got hidden debt, we've got odious debt, we've got lack of accountability and transparency around debt, is really adding fuel to the fire. And we must address the prudence of recommending the government access the SDR in with these two factors in mind and to look at what the remedies are. As I close, as a coalition, our position is that our debt crisis is politically manufactured, and that the political response is to deal with the aggravating factors. And the first aggravating factor is the lack of disclosure, which needs to be dealt with by full disclosure. So as civil society, we need to use this opportunity to demand full disclosure around debt. The other aggravating factor is the lack of effective oversight. Parliament has been bullied and acceded and co-opted into approving very imprudent borrowing. There's loopholes in our public finance system, but there's definitely a deficit of oversight accountability. There's a deficit of public participation. And these are more systemic issues that must be put center stage as we have this conversation. The other factor, which is immediately, an immediate concern, is the large amount of non-essential spending in the present budget. In the last two budgets, 2020 and the proposed budget 2021, has huge amounts of what we deem as non-essential, large kind of infrastructure projects whose productivity is questionable, whose contribution to growth is questionable. So the prioritization of where government is putting its money is a big issue. And as long as government continues to spend on non-essential projects, what we found this to be linked to legacy projects, then we will continue to run a budget deficit and continue to borrow and continue to place the burden on Kenyans. And this is the crux of the issue. So the last point I'll make is that we support government continuing to spend on the cushion as part of what they're calling this fiscal consolidation that does not take the strict austerity measures. But we note that fiscal consolidation also includes sealing corruption loopholes, also includes ensuring that those who are supposed to be paying tax do not evade tax through exemptions. And there's a need to look at that. Oh, and then very, very final note on a very proactive point. I believe one of the recommendations, there's a recommendation that has been made for a dove fund. And I saw this in one of the transcripts from Denise Namburete when she was talking about the Mozambique case on Afronomics webinar, talking about we need a dove fund for the continent that respects favorable borrowing terms and places both borrowers and lenders under due scrutiny, so that we get out of this kind of panic borrowing and negotiating on individual facilities that don't give us a sustainable solution. So should we not be thinking about drawing on the SDR to put into a fund that is more amenable to the African countries that need to borrow from that and get out of the kind of more individual troubleshooting, panic borrowing that we are seeing across the countries. So David, I apologize. I know I've gone over the minutes I have, and I'll leave it there. Thank you.
Thank you so much, Shiro, for that wonderful, well-laced arguments. Really making 5 major points in my view. The first one is on debt sustainability, where we don't seem to agree, and we are using, indicators, actually misusing indicators in order to justify the positions that government is taking. 2 is on really that there was already a fiscal crisis, which I agree with you, and this is the same across the continent in Africa. The pandemic really just exposed it and exposed our vulnerabilities. The third big point is the disconnect between IMF proposals and Treasury's positions, where we see, sort of on the one hand, IMF wants to encourage domestic debt, due to the volatility of our forex, but also government, on the other hand, espousing that, domestic debt, there's a view to reduce it. And also the questions around the favorability or the preference that IMF has on consumer taxes and the inequality that results in, particularly for our marginal populations. And then, of course, the big one, which is the lack of transparency. And you not only raise issues of a poor legal and institutional framework, but also the question around oversight, which I think is quite important, and how we prioritize within our national budgets. And I think, in my view, there is a huge planning inertia that we have that has set us on a path that perhaps is not sustainable. Because when you bring in this sector-wide budgeting and planning, it has its advantages, yes, but really the one big motive, the one big incentive is for government institutions and agencies to perpetuate themselves, even in spite of changing national prioritization and changing needs. So this is something that's very important. And then for me, the last point that I saw there is on the fiscal consolidation. We talk a lot about austerity, but it's like government wants to have its cake and eat it, in the sense that, they want to increase fiscal space, but at the same time, implement austerity that is not really austerity. So it's basically austerity on paper. We continue to prioritize non-essential items, as you've stated. And so, these are the key challenges that remain. And then circling back to the special drawing rights, the big question is, if already we have a dysfunctional debt architecture, does it make sense, therefore, to even pile on more debt, knowing very well that our framework is not working properly? So these are questions that we'll continue to raise, and I'm sure participants have also noted several other items that I might not have noted. So let me now take the opportunity to invite our next speaker, who is from AFRODAD, to now take us through, what really is this SDR and what is its applicability when it comes to the debt situation, and specifically the dealing with the pandemic response on the continent. So welcome. Thierry, please feel free to come on.
Yes, good morning, colleagues. Actually, we are supposed to be joined by Chiara Marriott, our colleague from AFRODAD. All right, that's fine. Let me share the PowerPoint presentation. Okay, yeah, that's fine. Okay, thank you very much, colleagues. Apologies for the delay. I will basically try my best. I know Chiara would have done it differently, but fortunately we have had these presentations, actually for twice now. We had one big event we held with the SADC Parliamentary Forum the other week. And last week on Friday, we had another opportunity to engage the Zambian colleagues on the same issue. So we had gone through this presentation twice now, and I'm sure and confident that I will try to bring some of the points for discussions today. So basically there are a lot of technical aspects of what special drawing rights are all about. And basically, from an IMF point of view, these are defined somehow as an international reserve asset that has been created by the IMF to supplement its membership. That is the IMF members in terms of the country's official reserves. And the value is based on a basket of 5 currencies, So SDRs are not necessarily in one currency, they are in almost 5 currencies, and these are the international currencies. Maybe you have the US, you have the Chinese, you have the Euro, and the other currencies. They cannot be held by private entities or individuals, and hence they are within the IMF for the IMF membership. An SDR allocation provides each recipient country with a costless asset which countries can use as they want with no conditionality. I think this aspect is very important, that the SDRs, in terms of the allocations, there are as per what they call quota of votes that each country has within the IMF. So they are allocated as per the country's quotas with respect to its votes. So basically, you will find out that a lot of our countries within the continent or sub-Saharan countries, since we have very little votes within the IMF or what they call the quotas, the allocations sometimes they are not as big if you have to compare with the bigger countries which have high votes or quotas within the IMF. Here we might be referring to the US, which have the highest votes and the veto vote, and the other big economies. So when it comes to SDR allocation, those countries are really going to get the bigger chunk of the allocation compared to sub-Saharan African countries. But when you look at the amounts themselves, regardless of the less votes we have, I think they are huge amounts relative to our economies, which countries can actually make use of in the fight against COVID-19 and have great impacts. There are no conditionalities. I think the point here is that the countries are free to use them as per their priorities in terms of development needs. So the funds will be allocated to a country via the central bank, and then the discussion on how to use those resources mainly happens at the national level. I think this is different from the loans we have seen from the IMF, where they come in with a lot of conditionalities. We have seen a lot of African countries currently going to the IMF for loans, and there are a lot of austerity measures that they are told to implement, and this has not gone well with the citizens in the region. So here we have SDRs are distributed in proportion to IMF's membership quotas. Around 60% will go, for example, to the global north. 40% will go to the emerging markets and developing economies, and 3% will go to low-income countries. And this is where we find the majority of our sub-Saharan African countries. So you see the bulk of it will go to the developed world if you have to compare to what we will get this side. A country earns the SDR interest rate on its holdings of SDRs and pays the SDR interest rate on its cumulative SDR allocations. Countries using their SDRs and therefore holding SDRs below their allocation pay interest, and countries holding SDR above their allocation and interest. And I think these are some of the technical aspects which I think when Mario joins us, we can raise questions around and what it means and how it's calculated. So far in the history of SDRs, we have 3 general allocations. I think the first one there was in the 1970s, early 70s, 70 to 72. Then there was the one 1979 to 81, and the last one was in 2009. I think all of us were aware what happened in 2008 to 2009, where we had the global financial crisis, and quite a number of countries were actually impacted because of the crisis. So to address that, I think the IMF almost allocated close to $250 billion that was given to the IMF membership to mitigate against the impacts of the global financial crisis. Another important point is that the approval of a new allocation is first proposed by the managing director. I think this is process-wise. how they end up being approved or allocated. So it has to be approved by the managing director of the IMF, then it goes to the executive board, and then it goes to voting, where an 85% majority of voting power by the board of governors is needed to pass through. But I think those who have been following the media, the international media and the regional media, in terms of what's happening with regard to the discussions, I think there's a lot of positivities from the SDR. So this is very important. But process-wise, this is how it is done. Hello, yes. Hi, Shara.
Yeah, I'm here. Good morning.
Morning.
Yeah, sorry for being late. It's early here. Shall I take over? However you like. Can you show me again what slide are you at, please? And good morning, everyone from Brussels.
Good morning.
Good morning. Okay, so let's share screen. So I think Thierry was doing an excellent job at giving you an overview of what SDR are and how they are allocated. Zooming in a little bit on how they can be used. As we said that, can you see the screen?
Yes, we can see it.
Yeah, okay, good. So they are a bit like an asset created by, you can think of them as a process by which a central bank creates new money. They're not exactly a currency, they're not exactly money, they are an asset, but think a little bit of a process similar to that. And when they are allocated to a country, then they are listed as reserves in the central bank. And the central bank can keep them as reserves. And even if they're not used, they are useful to a country because they increase a country's savings and its creditworthiness, which means that the country can borrow at more and better terms on financial markets. So they don't need to be used to be useful. However, they can also be exchanged in for hard currency and then can be used for imports, so addressing imbalances in the balance of payments, or for public spending, so helping to pay for public investment and increasing the fiscal space of a country. Now, the process by which SDRs can be converted into hard currency, it's a bit complicated. There is a system that is managed by the IMF that ensures that if a country wants to exchange its SDRs, there is always another country or an institution that will exchange SDRs for their currency. Now, what we have seen is that over time, the transactions of SDRs have increasing over time. And it's mostly developing countries that exchange them for hard currency and use them, as we were saying, for balance of payment uses, so to pay for imports or for public investment. But that also means that there are developed countries that are happy to acquire new SDRs and keep them as reserves in their reserve portfolio. Now, just to reiterate why we are insisting so much as civil society on this issue, which has not been on the table until now. Well, it's not true that it's not been on the table, but the COVID crisis has give a new fight, if you want, to this ask for creating new SDR, and so for increasing the global liquidity. And why they would be so useful in the context of the COVID-19 crisis. Because they would increase the currency reserves for a country, and that would make that country able to borrow at lower interest rates and engage in financial markets on better terms. It would help them address imbalances in the balance of payments, and it would help them increase fiscal space for public spending, COVID-19 response and recovery. As I said, it's like an increase in liquidity, as if the central bank was creating new money. Just as a side note, I know that has come up in other conversations, whether they would be inflationary. As far as I have read, the studies that have been done have shown that, at least on a global scale, the amount of money that we are talking about would not increase inequality. We would need much higher amounts to actually have an inequality, inflation. We would need a much higher amount to increase inflation. But of course, it would also depend on how they are used in each country, especially if they're used for public spending, for what type of spending they're used. Now, where are we now? I have to say that things are evolving really fast by the day. And I prepared this presentation about a week ago, I think a week ago, and things have already changed a bit from when I prepared this presentation. Anyway, how much SDRs have been called for, to give you an overview of what the situation is. In March last year, if you remember, when UNCTAD came up with a figure of $2.53 trillion being needed to address the needs of developing countries in tackling the crisis, they called for a new issuance of SDRs of 1 trillion. The ECA's Executive Secretary Rasongwe called for 500 billion, and so have the G20, and in particular there was the amount that the Italian presidency was talking about a couple of weeks ago. But then last week there was a G7 meeting hosted by the UK, which agreed on a 650 billion, and now it looks like the IMF may also come up with a number that's very close to that. More on the IMF later. What AFRODAD, EURODAD, and many other organizations are calling for is for something much larger, for 3 trillion. And this is, I'll show you why. I'll show some of the figures. But the bottom line is that whatever the amount, this additional liquidity is going to be helpful. But 500 or 650 billion are too small to address the challenge that we are facing. And this is due to the fact that, remember, only a minority of these SDRs would go to developing countries. This is a breakdown, this is estimates that a colleague of mine did, of how much would go to each region of the world with an issuance of 500 billion. You could see that developing countries would get around 31%, so 154 billion. Sub-Saharan Africa would get about 11%, so around 16 billion, which again, not an irrelevant amount, but still about half of public debt service that developing countries will have to pay next year. I hope you can see the, don't know whether you can see, sorry, the title of this graph, but this is comparing how much SDRs would go to each region with the external public debt service in 2021. And you can see that amounts would be about the double of what countries would get as SDRs, meaning that basically all these additional resources are likely to be automatically channeled to debt service payments and not be used for uses to tackle the crisis directly. So invest in health, invest in vaccines, invest in education, invest in energy transition. And so do all those things that really would make this an opportunity to recover from the crisis. Now with 3 trillion, things change a bit. Developing countries would get around 900 billion. Sub-Saharan Africa would get around 100 billion. And this is about half the amount of debt service repayment. So that would leave additional liquidity also to expand the fiscal space and expand public spending. Now, where we are, what is likely to happen? What is the political landscape? Now, I think you all know that one of the reasons why the new SDRs issuance has not happened yet was opposition by the by the Trump administration, mostly for geopolitical reasons. They didn't want additional liquidity to go to countries like Iran and Venezuela, but also China. Plus, Trump was Trump. So we are not supposed that he wasn't in favor of a multilateral solidarity decision. Anyway, things have changed. The Biden administration, and in particular Janet Yellen, the Treasury, have said that they are in favor. There are issues, however, on the amount. Why? Because if a new SDRs issuance were to be approved and the amount would be equal or below the existing US quota to the IMF, there is no need for approval to go through Congress. However, if we go above that level, above the US quota to the IMF, so to what if we go for an allocation of 2 or 3 trillion, then Congress has to approve this decision. And the Senate is against such a decision because Republicans are in the majority in the Senate. So 4 constraints that come from the US politics, if you want. The most likely figure is going to be around 680 billion, which is the maximum that can be approved by Treasury alone. As I said, we know that the G20 was talking about 500 billion, G7 650 billion. The IMF is making is keen to make a case for a large allocation. We know that internally they support the measure, and that they are aware that 500 billion may not be enough. But given the circumstances, it's a figure between 500 and 650 is what is likely to happen. And then I think I'm almost done. What I wanted to add is that there is room, there is a possibility for a second allocation in the future, because the IMF works in 5 years period, and this allocation would happen in the 11th, which would leave space for another one next year, but we need to make the case for that. And then the final thing is that you probably have heard a lot of discussion on reallocation of SDRs, because no matter the amount, most of the SDR newly created would go to developed countries. So there is a lot going on in terms of how these SDRs would be distributed to developing countries. Now, of all the discussion that you're going to hear, remember that not all of them are actually feasible in practice, because there are some rules that regulate how SDRs are used and what can be done with them. And let me repeat them. They are a reserve asset. They are not a currency, so they cannot be automatically allocated to specific projects. And for that, they need to be exchanged in currency first. Any reallocation can only be voluntary, and no conditionality can be applied to SDRs. So this limits the way in which any reallocation mechanism can work. What the IMF is actually looking through different proposals. The most straightforward thing for them is that to ask countries, developed countries, to allocate excess SDRs to the PRGT funds, the Poverty Reduction and Growth Trust Fund, which is the fund through which the IMF make loans to developing countries, meaning that basically this reallocation mechanism would just increase the lending capacity of the IMF, which would channel these resources through loans, so creating new debt with conditionalities. So it's not a very desirable mechanism. Other conditions, other options that are being discussed are funds for climate, for vaccines, for social protection, but they are all, as I said, the mechanism through which they can be created is a little bit tricky. So this is an ongoing discussion. I don't know where it's going to land. I do think that what is very important, it's still very important for African countries, is to continue to make the case for additional liquidity to be needed. So to create how this, so to show, to demonstrate to the IMF and to the G20 why this additional liquidity is needed, and also how it would be created by each country, and also possibly to make their own proposal of how SDRs could be redistributed and how they could be used to address the COVID-19 crisis. And I'll stop here, but I'm happy to take questions. Thank you.
Thank you so much, Chiara and Thierry, for that wonderful introduction to special drawing rights, their use, how they are allocated. It certainly does raise the big question about the imbalance that we have. And you've certainly already raised the question about, even if we do have more allocation, the proportion that goes to sub-Saharan Africa will still be little. And so there's validity in the conversation of reallocating those SDRs and to have that debate at the global level. So at this stage, we did have a confirmation from the Institute of Economic Affairs CEO Kwame Wino, who would give us, as a discussant, his remarks. He was to log in. He might join us as we go on, but just to not to hold us hostage, I think we can now open up the floor for discussions. We've had 2 presentations, and I would say also the opening remarks from Jason also are quite valid for us to respond to. The big thing here is we see that, from AFRODAD's research and the support from EuroDAD, is that there's a case for greater SDR allocations. The argument is to move this to 3 trillion. I think in my view, I would like to understand where the number 3 trillion, I do understand that, you want a bigger proportion available for developing countries, but why 3 trillion in this respect? And then secondly, the big question is how do we actually achieve that advocacy target? How do we get, global leaders in this case to shift that conversation, moving from the figures we've seen there to the figure that we want? I think also we also have to circle back to the initial questions that Shiro had raised around the legal framework, the prioritization, and the core questions that we have within debt management. Because if those do not change, then it doesn't matter, how much more opportunities we have as Africans in Africa, as well as Kenya, given that this is a mostly Kenyan forum. And then circling back to the issue of the SDR not being a silver bullet, and the conversation that is going on for extending the DSSI. For me, some of the questions that come to my mind are, first of all, how have we used the DSSI so far? Have we had an accountability from governments? And what are the transparency mechanisms around the SDR? Are they any different, or does it still suffer the same challenges that we see? So those are just some of the things that I'm thinking about, but I'd like to open up the floor. I do understand that not all of us got an opportunity to introduce ourselves. And so if you do raise a question, please introduce yourself and your organization, so as we note down your question. You have got, you can raise your hand. There's that feature for Zoom, but also remember because you're live on Facebook, you will unmute, but also provide us with a video if possible, depending on the stability of your internet, of course. So let me open it up for questions. Anybody who's got a burning question, just bring it to my attention and then I'll call you out. You can use the raise hand feature. Anybody?
David, oh.
Yes, Shiro, you want to say something before I come to the hands I've seen so far?
Just a quick one. What is AFRODAD's call to action? After all this, what next? Thank you.
Thank you for that. I think we will note them. I saw some hands before from Imali, though it's now dropped. If keep the hands up so that we can, you only put them down after you've been called. So Imali, please go ahead and raise your question.
Thank you very much. I hope you can hear me. First, I think Ikonyo went ahead of time and asked one of the questions I had, but another question I had, which I'm yet to understand, is last year Kenya was ranked, I think, #3 best economy by IMF. I think we were third because the shilling against the kwanza did very well. So I do not understand, I'm not an economist, so please help me, because I do not understand how we shifted from that to a point that we are almost in recession, to the best of my understanding, just trying to understand the discussions that ensued this morning. So that's my question. If there's any economist in the house, if you could kindly explain, I would be so happy. Thank you.
Fantastic. I've noted it down. Anybody else? Yes, Benjamin, go ahead, please. Unmute and Benjamin, go ahead.
Thank you, Dave. Thank you, David. My name is Benjamin Musungu from Kenya Private Sector Alliance. Just wanted to throw in a quick thought on SDR, consequences of SDR. What are the chances that it would potentially trigger inflation? That's my first question. And the second question is that now that this resource doesn't come with any conditionality, are there any checks and balances to ensure that there's prudent use of the resources, especially from the government side? But maybe you can highlight one or two. Thank you.
Thank you. Thank you so much for that. I'm seeing Andrew Gogo's hand also up. Andrew, please go ahead.
Yes, thanks, David. Sorry, I'm not able to put on my video because of my connection, but yeah, I'd just like to sort of echo some of the sentiments that have been raised in terms of whether, as a country in sub-Saharan Africa, whether Kenya, really requires the SDR. And I think someone mentioned in terms of, what's our call to action? I mean, what are we trying to advocate on? What are we saying that, Kenya, what's the allocation that, Kenya would require in this, in terms of the SDR? And in terms of, the economy, I think the IMF, has projected that, the Kenyan economy is going to stabilize towards 2021 from the contraction, experienced last year due to, the economic situation from the spread of COVID. So are we saying that, we really need to increase sort of external borrowing, whether concessional or non-concessional, considering that the government has already, introduced measures, internal measures in terms of, tax policy to sort of go towards, the expected, debt repayments. And the other question is, yeah, it also links to the first question in terms of, whether Kenya really requires to explore the SDR route, especially considering just recently the IMF has sort of extended the rapid credit facility that Kenya was granted last year, around $736 billion to 2.6 3-year facility just recently, I think, in the past week or so. Which will go towards not only stabilizing the economy, but also towards the efforts to combat the spread of COVID, but also the efforts by the governments to ensure that the markets have sort of been stabilized, and this also goes towards supporting the balance of payments. So are we really in need of the SDR? I don't know about the other countries in the sub-Saharan region, and from what I've heard is that currently, let's say around 500 billion is what 500 to 600 billion is what could be accessible to, to sub-Saharan countries. If you divide it equally among the countries, then that means, around 300 million US dollars. And if you look at it in terms of whether that would be enough in terms of even going towards debt repayments and all that, I don't think that would be sufficient. And if we're saying $100, I mean, we still receive around each country will receive around 2 billion, to go towards that. And, that obviously has a lot of, bureaucratic processes attached to it. So my main question is, are we really in dire need of the SDR as a country, considering that, in the history, most of the developing countries have sort of changed the SDR, not only for the national reserves, but, as, concrete money where they can use it as they please. And considering also, the financial management mechanisms in the country where corruption is rampant, are we really in need of the SDR, or could we then explore other avenues? I know the SSI, is a good, alternative where we can then, come up with internal solutions on how to combat the increasing debt. So that's my question. Thanks.
Thank you so much, Andrew. So let me stop there for now to allow for our presenters to answer the question. And it's really a free hand. You can pick whichever question is relevant to you. And then at the end, we'll see if there's a floating question, someone can pick it up. So I invited, I can start with perhaps Jason, and then Shiro, and then lastly, Chiara.
Okay, thanks, David, and thank you to Chiara. I know it's very early in Brussels. I hope you have a coffee next to you. Thank you so much for making the sacrifice for joining us. And thank you to all for the questions. Maybe I'll just start with the clarifications and then just combine a couple of questions. So I'll probably combine, David, your question on DSSI with that of Andrews, who's just asked that, and then I'll combine also the SDR question that Andrew has asked with yours again. So on the 3 trillion figure, this figure came about from an UNCTAD report that was written towards the end of 2019, 2020, and into 2020, that sort of estimated what the macroeconomic fallout was going to be from the COVID-19 pandemic. And they got close to about 2.5, 2.6 trillion US dollars. That was their estimate that was needed to actually get developing countries, not in terms of just cushioning them, but actually jump-starting the economies and having investment in social protection and health investment to deal with the immediate impact of the pandemic. So that's where the 3 trillion figure has come from. So it is a UN figure. It is an official figure that has been published in a UN report. And so as civil society organizations, we have taken that figure and used it as the top end figure, which is sort of your best case scenario when it comes to negotiating that, if we got 3 trillion, that is sort of the best outcome that we could get from the SDR allocation. Of course, UNECA, the finance ministers from the African Union, the G7, and many others have now sort of gravitated towards this. Now it's about 680, 690 billion figure, which is at the moment seems to be the one gathering the most momentum, as Chiara mentioned, for a first stab at getting some immediate liquidity out there into developing countries to deal with the impacts of the pandemic. But there is an opportunity in the future to then up that figure towards and get a bit closer to the 3 trillion figure that we're advocating for. So that's just sort of context. And we can share the UNCTAD report with colleagues to use it as a reference to understand how they came up with the figures, but there's a combination of macroeconomic stability versus debt versus investment in health and social protection resulting from the pandemic. The DSSI, look, I think when I mentioned this at the beginning during my remarks, there is no single instrument that civil society organizations, AFRODAD included, is advocating for, right? It is a combination of different instruments and how they generally work together to give each country, each African country, the best outcome in trying to renegotiate and deal with the debt crisis that they're facing. So it's not a case of saying the DSSI is better than SDRs, or the SDR is better than the G20 framework, or the G20 framework is better than all of them, because in each of these instruments, and you know, we can't forget that the Paris Club offers as well. Each of these instruments or avenues have their strengths and weaknesses. The question is, how do you combine as an African country, sit down with the negotiators and come up with the best solution? That's the first step. The second step is, how do we as civil society and as AFRODAD, how do we galvanize a unified African position as civil society, but also as convincing African Union finance ministers to come up with a singular position of how to deal with the best policy combination when negotiating, and therefore strengthening the hand in the current place. So I think that sort of inadvertently may answer Wanjiru's question about what is our call, and you know, in terms of our call to action, it's to sort of determine what is the best combination of instruments to immediately deal with the crisis that we're facing, and then in the medium term to then come up with a more harmonized voice around dealing with future issues around debt management and the debt architecture. On some of the questions around the triggers to inflation and related to tax, given the economic, I mean, in Kenya's context, given that there has been a significant decline in economic activity, and to those who seem to prefer very much the IMF forecast, I think this is all about also managing expectations as well. And I think it's important to be clear, you know, the economy has shrunk. There's no doubt about that. I don't think you need to be an economist to appreciate or understand that. I mean, you just need to walk around the streets of Nairobi or any other part of the country and speak to people, and you'll get a sense of, you know, what really is happening. So I would hazard very much against preferring the IMF projections that we're going to stabilize and rebound to things like 5% in 2021. I think that's, you know, with the current third wave sweeping over the continent, travel is still heavily restricted. Our economic output is still relatively low. Our foreign exchange earnings is still, you know, is still nowhere near showing signs of recovery. I would hazard really on flouting those type of voices and messages, because I think it's more about curtailing and managing expectations of economic agents than really a true reflection of what is actually happening in the country. So in terms of that, I think, you know, the SDR allocation may not necessarily trigger inflation. What we need to be careful of is that the central bank is able to actually hold onto the currency, and that there isn't a further depreciation taking place when the allocation actually is made. So that for me is that would be the biggest avenue to worry about, because if we do have a further slide of the Kenya shilling against the dollar, then yes, we are likely to see inflation, but nothing to the extent like maybe, you know, we'd have seen, let's say in Zambia or in Zimbabwe. I think the economy here is slightly more stable and slightly more stronger and resilient, but nonetheless, you know, holding on to the currencies is really, really important to avoid that. And remember, the SDR allocation is all about also creating liquidity where there isn't liquidity within the public sector to kickstart the economy, right? So it's not necessarily money that's going to be circulating freely within different sectors. So I think the inflationary risks there are not as high or not as pronounced in the Kenyan context, I should say. With regard to taxes, I think maybe Wanjiru could maybe come in here, but I really want to caution here. I mean, we've already seen the tax instruments take a bit of a battering when it comes to the impact on citizens. I mean, you know, fuel prices have gone up significantly in the last 2 months, and who's to say that there's not going to be a third increase there? You know, we're sort of also reaching the wave where the exclusion or exemptions that the government has been providing under COVID, you know, many of them have come to an end. So I think we need to be very careful. Tax revenues aren't growing. There's already a projected deficit for this fiscal year by the Kenya Revenue Authority. So when we talk about tax policy, that we have a good tax policy, that we don't need SDRs to cushion us, or we don't need sort of debt relief or debt restructuring. I'd be interested to pick this up with Andrew at a later time to actually interrogate how exactly he views the tax balancing out when the economy is almost stagnating, if not receding in certain sectors, on how that comes out. The biggest worry with the current conversation around the debt relief and the debt restructuring is that a lot of the fiscal space that's going to be created in Kenya and in many African countries is actually not even about the corruption. It's actually about diverting the extra or the additional fiscal resources away from social spending, away from jumpstarting the economy, to actually paying off the private creditors, because they're not part of the negotiations right now. They're not part of any of the debt relief or debt service suspension programs. So they're not part of the DSSI. They're not part of the G20 framework. So that is the biggest concern, is that any fiscal space that's created is actually going to go towards creating or redirecting the money back into paying off the private creditors. So I think that those are the kind of key things that we as civil society and we as AFRODAD are really paying close attention to here on the continent, and with colleagues like Chiara in EuroDAD in Europe, that we're really tracking very, very closely, is to see how these different mechanisms work. And lastly, on understanding the dynamics here with the different initiatives, the ecosystem on the debt architecture has the debtors, the creditors, and then there's one set of stakeholders that, you know, that really is, or that are really playing a major role here. And these are the credit rating agencies. Chiara has mentioned it, Wanjiru mentioned it. Credit rating agencies are playing a very negative and mischievous role in this entire conversation by threatening to downgrade the ratings of countries that seek any sort of debt relief or debt restructuring. And as a result, many of our finance ministers are very hesitant to take on or sign up to things like the DSSI, the Common Framework, because they don't want to affect or impact their future ability to borrow. So there is an important need here also for civil society, and this is what AFRODAD, together with organizations like EuroDAD, our friends in Latin America and in Asia, are working very hard to try and get some sort of resolution that caps the power and the behavior of rating agencies in the current situation, so that it doesn't force developing countries or back them into a corner. And you'll recall, actually, the finance minister here in Kenya did admit earlier this year that the reasons why the Kenyan government was slow to access some of these was they were afraid of losing out on their ratings by the credit rating agencies. So, you know, these are real threats that policymakers are facing, and as civil society organizations, it's our job to, on the one hand, hold our governments to account through transparency and accountability, but at the same time, it's also to call out the inequalities and the power imbalances that exist at the global level with regard to the debt architecture. So I know I've taken a long time to explain and respond to these questions, but I thought it's important to bring in both the technical but also the political dimensions that are at play here. Thanks, David.
Thank you so much, Jason. I allowed you to go on because some of the inputs you are making were actually quite meaningful for tying together the entire session. Now, I want to interrupt this session because we have now online the CEO of the Institute of Economic Affairs, Kwame Owino, whom I'll give time to as a discussant so that he can give us some of the views that he had prepared for us. So Kwame, just feel free to connect on audio and video and come online.
All right, thanks a lot, David and everyone. I don't know how much time I have, but my apologies, I was in a different meeting which ended just a couple of minutes back. Now, I'll be making 3 points. The first one is that, and I'll speak specifically about Kenya. I avoid the idea of aggregating all African countries and saying this is the African debt problem, because it's not one. And in some cases, in Kenya's case, it was just caused by complete hubris. So that's the problem. And then it collides then with a serious pandemic situation last year, which delivers both a supply side shock and a demand side shock. So obviously government has little revenues. There are problems with the ability to pay. And for that reason, some kind of arrangement or facility with the IMF becomes necessary. The terms of that, of course, are things that are still being debated, but it's clear. So why am I, so what do I have to add to this? My view about this, first of all, is if you think about Kenya, and I know the question about the availability of vaccines and all that. Before I come to SDR, let me just talk about the availability of vaccines. Even at its most expensive, and some of the most expensive vaccines, and again, I'm using public information, all these vaccines come from about $3-4 per dose, all the way to, I think, about 30 or 40, 33, 38, what I saw just before I logged in. If you think about the number of Kenyans in here, available in Kenya, so that's $40 per person, it shouldn't be, and I say this advisedly, the government of Kenya shouldn't have to borrow money or seek indulgence to actually be able to pay for the vaccination of all Kenyans. Shouldn't. Why? Because based on a report made by the government of Kenya, by the quarterly report, and obviously the reports by the president at the end of last month when he was talking about the extension, the loss per month, the economic loss per month because of the restrictions coming with COVID and its management, are about $70 million per month for Kenya. $70 million a month for Kenya. So this has been over 8 months. In its view, the first 8 months delivered almost $500 million of loss in GDP. $500 million of GDP. So that's a lot of cash. If you think, so my view about it, my view about, no, rather it's about $500 million per month, coming down to almost $6 billion over the rest of the year. So it's quite a lot of cash in terms of the loss. So the cost effectiveness of just buying a drug or a vaccine. Now, I keep aside the questions about the supply constraints, but if you talk about just the ability to effect demand to raise the capacities production, the government of Kenya need not be lining up anywhere and actually negotiating or claiming that it needs more help than, so it should not have it's not something that should have been the constraint. And my calculation is even based on the median price. The idea was that the entire population of Kenya could be vaccinated within a year for less than 1 percentage point of GDP. So that's the situation. But why are we here? We are here because obviously public mismanagement, the questions of public debt and how we got here, a position of debt distress, and a government that's not even paying some of its workers. So I know that there are public sector workers who've been away for who've just received February salaries at the middle of this month. So obviously some lag of about 6 weeks in terms of payment. So that's the situation, and that's not really a good situation. So if it comes to the special drawing rights, it's true that I think this facility was meant for shocks such as the one that we have. I accept that part of the shocks is just basically improper economic management or imprudent economic management. So the claim for them is something that Kenya needs to make, even if, in my view, a country such as Kenya, given its quote-unquote economic fundamentals loosely used, should not have been in a place where it needs to borrow $1 billion to vaccinate citizens. Just looking at the numbers alone, it need not have. Why? Because the government of Kenya collects on the average about $50 million a day in taxes. And coming to that, I mean, what it would take is just basically something like one month worth of revenues to be able to do that. So that finances are so tight that it cannot make any adjustments, even in such conditions, in my view, reflects the public mismanagement. So I understand the situation in which the government is, but I don't think that the government of Kenya, and I speak specifically for Kenya, should have been in a position where they needed to negotiate Sdr rights to be able to actually pay for vaccines, just the recklessness. But as it is, I think that the facility, as members and responsible members, the very facility of Sdrs and the ability to actually use them for a financial crisis or a crisis that affects the economy and has other downstream effects, suggests that it's the right place to actually be able to apply for it. And obviously, I know what will arise is whether that money will be used, because we know cash is fungible. So when it comes around, it's also something that can be afforded, because the IMF has some deep reserves based on just the amount of money that's been available in other cycles, the financial crisis that we've seen in other parts of the world. So obviously, I think this is a facility that could be called upon. So as I end, I say that I agree that these facilities were made available, or rather, this design is compatible with the demand for, or rather with the request for support as is required. I think a country such as Kenya cannot delay or should not delay inoculation of citizens, partly because obviously it will start other cycles and its effect on economic, I mean, the slowdown will not happen. And as you all know right now, there's a third wave in Kenya, and without quick inoculation, one of the things that will happen is this will repeat itself every 3 or 4 months, and the possibility of a recovery will be delayed, in addition to obviously making the debt distress question actually go back. Aggravate the debt situation, which might lead to a very hard landing. So that's the point. So as I conclude, Kenya need not have been here, but as it is, that's the reason it is. We understand those reasons: imprudent management, and I hold the government of Kenya and Parliament in particular completely responsible for the situation in which it is, whether with the private debt, whether with the bilateral debt, or whether with the debt with other institutions and its management. Here we are. But I also understand that the reason these institutions exist, I call them the global cooperative societies, is the IMF exists to help countries in facing the kind of shock, partly as a matter of accident, but also partly because of imprudent management in the previous 5 years. And that's where we are. So yes, it's a prudent thing for the government of Kenya to actually seek very, very quickly to try and close this by asking for some cash to enable it to perform this emergency function. Thank you very much.
Thank you so much, Kwame, for that very pointed and very strong point that you made. I think for me, the big takeaway is that, with a month's revenue, actually the government can be able to implement a vaccination program, the entire vaccination program that they want, using even, a very costly model where you're averaging about 18 to 20 shillings per dose. I mean, $20 per dose. So I think that's a big headline for me. So thank you so much for that. And also, I think the other thing is that, you tie it all down to mismanagement, which is a big indictment to, how we do not only the general implementation of government, but specifically our planners and our budgeting people. So thank you so much, Kwame, for that. So in addition to that, I'll go back to our presenters, and Kwame, you will be free to also respond to questions that come along. To answer or to address some of the questions that Jason might not have addressed, or to sort of reinforce perhaps or emphasize points that you feel are necessary to enforce. So I'll now invite Shiro to come and also give her inputs before I finish with Kiara. So Shiro, you're welcome.
Thank you so much, David. I don't believe there was a question directed at me, so I'll make just two brief observations. First of all, I totally associate myself with Kwame's remarks, and also with what Andrew said, and I think they tie in quite well, that Kenya did not have gone for this. The potential impact is not, commensurate to the extent of, to the level of indebtedness, but because of financial mismanagement, we are forced into this situation. So my two reflections are, there's a loophole that we have in the debt management, whereby once the debt ceiling is approved, Treasury is then free to negotiate debt facilities without referring back to Parliament. We've really lost confidence in the oversight role of Parliament, but the very fact that Treasury would be forced to table, the required, the contracts and such before Parliament gives an opportunity for public participation. Now, the other loophole associated with that is around expenditures. Once money is borrowed, once it's put, particularly if it goes into general support, there's no way of tracking where the money goes. So much as Kwame is making the assumption that this money will come for COVID vaccination, it could go for anything. So how we know we need the money, but do we need it without closing this loophole? And how do we position ourselves to ensure that this money is prudently used? It goes directly to something as pointed as what Kwame said, or if it's shoring up the exchange rate, then it goes specifically for that, and there's a proper tracking mechanism. I think the second issue that Jason brought out is the issue of the credit, the global debt architecture. And you talked about the Paris Club. Maybe there's need for a conversation about the London Club, because, that is the dark hole, really. For Kenya, it's that, and also bilateral debt with China that are a big strain on us. So we possibly need to think about strategies around that. And yeah, thank you.
Thank you. Kiara, please go ahead.
Yes, thank you. Thanks so much for the questions and all the comments. I'm going to make some points which hopefully address some of the thoughts that have come. And let me zoom out a little bit, because obviously we are having this conversation in the Kenyan context. But let me look at the issue of SDRs from a little bit from a global point of view. And I think there are two premises. One is that in the next 10 years, all countries in the world are going to need a lot of money to do, first of all, to address all the problems that come with climate change. And if we want to be able to engage in an energy transition, especially one that is just and inclusive, there is a lot of investment of all kinds that need to be done that are going to cost a lot of money. And then there is the whole SDGs agenda with a lot of things, again, that need to be done in the area of education, health, job creation, social protection, infrastructure, environmental protection. That I know it's a very naive way of expressing it, but they're going to cost money. And again, this is true on a global level, on a global scale. And we don't have global economic governance and an international financial system that is adequate to support these huge tasks. This, I think, is the starting point of all of these conversations, that the ecosystem, the global economic governance in which this crisis has exploded is a highly imperfect one, highly unequal and unjust one, and that is not exactly designed to address global and multilateral crises like the one that we are experiencing now, but that we were experiencing already in 2018 and 2019 with the policy crisis and the climate crisis. So in this context, the mechanism by which the IMF creates these special drawing rights is the closest thing that we have to global central banks that creates liquidity. In fact, the whole idea behind the special drawing rights was exactly to have the IMF doing something similar to a central bank. Then it was this idea and that mechanism that would have made it so was basically slashed away, again, mostly because the US didn't want composition in that area. But that's the closest thing that we have. And if the IMF, when the IMF decides to do a new issuance, it's something that happens for all countries, for all member countries, and that actually, if anything, benefits developed countries more than developing countries, but it happens unconditionally for everyone. And so it's not ODA, it doesn't work along those mechanisms. It doesn't need to be negotiated, it just happens. And for me, the way that I see it, it's an opportunity to have this additional liquidity to do all the things that all countries will have to do in the next years. Now, in terms of the difference that they can make and whether they are inflationary, whether they are subject to corruption, how to make their use accountable and transparent, then that becomes an issue of the national level. A country might as well decide to keep this additional liquidity as reserves in the central bank. As I was saying before, even if they're not used, they are still useful because they will improve a country's savings and position on financial markets. Obviously, if they are spent, then there is a huge role for civil society at the national level to make cases for how this money should be spent, to make cases for additional transparency and accountability mechanism, but then that becomes a national level discussion for which the role of civil society is hugely important. And I mean, I have to say that it's incredibly interesting how, especially in countries that are used to do with limited resources, suddenly facing the option of having these resources and having to spend them well creates a lot of problem. I mean, I'm talking about my country. I'm Italian. I mean, I don't know to what extent you follow Italian news, but the government 2 months ago felt exactly on the issue of how money that is supposed to come from the European Union should be used and spent. So it's not an irrelevant problem. It's a massive problem, and if this liquidity comes, it does need to be followed and accompanied by a lot of support and work by civil society to make the case, to show, to demonstrate to governments how they should spend this money. Now, two more things. On debt relief, obviously debt relief is preferable for the simple reasons that it's fairer, that it's a more just way of creating liquidity and creating resources for developing countries, because a lot of debt was created in an unfair and unjust way. So this for me is just to be seen as in addition. The last thing that I wanted to address is how we make this happen, how we make this all this additional allocation happen. What's the strategy? I am going to answer this question thinking of what we as EURODAD are thinking about, but different organizations may approach it in a slightly different way. But for me, the first thing is demonstrating why this additional liquidity is needed. Show how this money can be used and show where the needs are, quantify them. And this is a lot of research, basically. Good old solid research and a little bit of analysis demonstrating the needs that countries are facing. And the second thing is that, I mean, we in Europe, in developed countries, we will be making this case, but obviously it should be coming from African countries, from developing countries, from governments to say, we need this money to do this and this and these things. And this is to make the case for a large allocation and possibly a second allocation in the very near future. Then there is the whole issue of reallocation of SDR by rich countries, because they're going to receive a lot of liquidity that in this case they maybe don't need. And again, I mean, what would be ideal is to have countries from the South voicing their views on how this liquidity should best be used. And in this case, a case can be made that it is used for debt relief, to cancel off, to buy off debt of developing countries. Let me just check. I think I've said what I wanted to say. Yes. So these were my points. Bottom line, I think that it's on all of us to continue to make the case, to demonstrate why this money is needed, why what are all the things that need to be done, starting with vaccinating people going on.
Okay.
Thanks.
All right, thank you so much, Kiera, for that. I think for me, the big idea is, you know, you've got a whole lot of development priorities as Africa, and liquidity will be one of the challenges. And so if we look at the SDR within that broader context, then it can offer additional resources for us to use in meeting those development challenges, such as climate change and all that. And I think the challenge that you've now placed before us as civil society members is that to ensure that at the national level, we have the right advocacy through research and informed evidence-based policy making, so that we can make the arguments, in terms of, how would we use this additional liquidity, and what are the transparency questions that need to be addressed, and all that. So I think that's a very, very, very vital point to address. So because of time, we only have now 10 minutes for us to provide our questions. So I'll allow for, very quick, very brief, very pointed questions. Please don't give contributions, just ask questions. And I can see Luis Kizito's hand is up, so please just go ahead.
Yes, hello, can you hear me?
Yes, we can hear you.
I have 3 questions, but you'll excuse my last question for being a form of comment. 1, my question again goes to Mariotti. I think I encountered her in a different platform and we were discussing the reallocation element. 1, how can we make sure that the reallocation that comes from countries like the United States, the UK, of SDRs, because this issuance, this allocation certainly won't be enough. However much we increase the allocation of issuance of SDRs, less than, I think, 17% will go to African states. So therefore, the supplementary function of reallocating is key. Now, my question in regard to that first element is, 1, how can we ensure that the reallocation, in our research and everything, the reallocation is not turned into conditional loans, but it remains a form of something akin to the central bank printing money. That is 1. 2, in the long run, can't we, in the long run, of course, this is not immediate. I've read through the IMF articles of agreement, a governing document of the IMF. I find it very unfair. I find it very Eurocentric, very Americas-centric, and less to do with Sub-Saharan Africa, Latin America, South America, and Asia. How can civil society leverage continental power to actually push for the reform of the Articles of Agreement, so that at least once in a while we have a board, an IMF executive committee or board that has some kind of Africa-centric mindset? And lastly, this is the last question. We realize that the US, like you said, and the UK don't need this liquidity as a result of an allocation of SDRs. 1, because the US passed the CARES Act, and in that CARES Act, 2.2 trillion, I think last year, literally the Federal Reserve printed money, and they could afford this because the US has the reserve currency status, and they will suffer very little currency damage or inflationary tendencies from printing more dollars. So for them, they may not need the SDRs, but they're going to have excess of them. The question in regard to this is, how can we convince the US or the UK to make sure it's not an expenditure for them for us to exchange these SDRs for their currency? Because we realize it's not automatic, like I think you have said already. It's not automatic that there's a liquid market that you're going to go and exchange your SDRs for freely usable currencies. There should be a buyer. Now, how are you going to convince the developed economies, which actually will just keep it as a reserve asset on their maybe central bank balance sheet? Yeah, that is all I have to say. I hope I did not go over the place. Thank you.
Thank you, Luis. Please go ahead and provide an answer for that, Kiara, if you can.
So, I mean, you're raising the big challenges, so I don't have straightforward answer. In terms of, I mean, and as I said during the presentation, the discussion on reallocation is ongoing. There are a lot of proposals on alternative uses, on how it can be channeled to developed countries. There are constraints from the IMF itself that come from how the whole SDR sinks here is designed. One option that I think should be the favored option is that the developed countries donate their SDRs to the IMF, but not for them to go into the poverty reduction and growth funds, which, as we said, is the one that is used to make loans, but to go to the CCRT, the Catastrophe Containment Reserve Trust, I think it's the acronyms. Anyway, it's the funds through which the IMF makes debt relief, cancels off debt of developing countries. So that, I think, would just be the favored option. The problem is that there are several countries that cannot do it by law. For instance, the UK, this option, this of donating the SDRs for debt relief is not allowed by law. So it would require work at the national level to change that law. It's not impossible. It's not an impossible thing to achieve, but it's definitely more longer term. Now, because at the same time, these conversations on creating funds for climate change, for vaccines, for social protections are ongoing, I think that, and to answer your question, Luis, on how you would convince developed countries is, I would say, make your own proposal. Think of how you would want to use this liquidity. What kind of fund would be useful for African countries? Where would you put this money? How would you put it for climate change? How would you use it for health spending, for infrastructure spending? You as civil society, think of what you would like this money to do. Make the case, bring it to your government, and then ask your government to bring it to the IMF board, to the spring meeting, to the annual meetings. I think that as a general, I mean, this is true for civil society everywhere. Need to make our own case and give our own alternative, because without that, it's what we ask doesn't go far. And sorry, I don't have more practical and short-term answers for you.
No, Kiara, that is absolutely fine. I think you were able to respond properly. Jason, I'm seeing you're on. You want to make a contribution?
Thanks, David. I mean, mine is just to echo what Kiara has said, but also to emphasize that there are many moving parts in this current conversation, and I think this is why it's important for forums like these to galvanize civil society action and civil society voices around these very complex issues, because the moment we are not harmonized or singing from the same hymn sheet, then the fragmentation makes it very difficult for us to engage at both the national, continental, and global level. So I think it's, you know, a session like this is very important to bring us all together. And, you know, we may not all agree on every single point, but if there are 2 or 3 things at the fundamental level or at the core that we agree on, then we can use those to move forward in the conversation. And I think the special drawing rights issue is one of those, given it's very topical, it's very important, it's going to play a very crucial role together with the DSSI, the common framework from the G20, and the other relief facilities that the IMF has put forward in getting our countries out of this crisis. So I think I just wanted to echo that and complement what Kiara has just mentioned. Thanks.
All right, fantastic. Let me still open up for questions. Are there any questions? Maybe someone has a burning question before we come back to our presenters to wrap up. I cannot see any hands. Does that mean that the presenters did a very good job in informing us? Okay, I think also it's understandable. It is now 11 o'clock. Let me take the opportunity to invite our presenters to sort of make their closing remarks. I'd like to start in the fashion which we had them. So I'd like to start with Kwame, and then we go to Kiara, then Shiro, and then finish with Jason. So if Kwame, you are online here, we'll hear from you. Yes, okay.
Okay, thanks a lot. And again, my apologies for having dialed in late. But I just have two comments. One is I think what the convergence of public distress that some African countries and specifically Kenya suffered from, and the emergency of COVID just tells us how important it is at all times for those of us who work in CSOs and in think tanks to always remind ourselves that good economic governance matters, and it especially matters when you cannot foresee a crisis and then it hits, because I think that's one of the things that has really limited the options that government has. The second one, and I think I mentioned this because if there's a lesson that African countries must learn, which is a sad lesson from the COVID crisis and of course the vaccine nationalism that we've seen, I actually agree that African countries could have put in more money at the beginning and actually been part of the development of vaccines. It would have helped their position. But I think one of the things that has happened is that vaccine nationalism, for good and bad, but especially for bad, has destroyed global solidarity to work on other problems such as climate change. And that's really, really sad. And the reason it's sad for me is that if, say, some countries, and it doesn't matter, I mean, countries, whether it's Canada, the US, whatever other country in Europe or other parts of the world, have 5 times as much vaccine dosage as they could, and it's just being stored. It's very difficult when people are dying, or you can see the risks to people, to then argue that for something that's a little distant in the form of climate change, you will ask everybody to put enough food. I'm so sad that global solidarity has actually collapsed. And it's going to bite us back in a very difficult place, because in 2 years, we'll be back to say, look, the vaccine question has been solved. Let's try to work. And it's just shown that nationalist interest and short-term thinking is something that the world is still not capable for. So let's all work together to whatever it is we need to highlight how some of these nationalist moves affect global commons. And global commons are actually going to become an important part of global economic governance in the few years that come, in the years that come ahead. But I'm sorry to conclude on such a note that I'm not optimistic at this level. I think there's going to be a lot of diplomatic cushioning ahead before people can step back on the global platform and simply say that questions of solidarity and global solidarity are really. Thanks.
Thank you, Kwame. Let me invite now Kiara to give her concluding remark.
Yes, thank you. I don't have much to add, only that I continue to think that we should all see this huge crisis as an opportunity, and given that we are talking of, again, of global economic governance, to ask more of institutions and of governments in terms of how they respond in a multilateral and way that is based on solidarity. And we need to keep raising the bar of what we expect them to do. And I mean, the SDRs discussion for me is just one of the things that we need to keep arguing and advocating for, to try to change this unjust system that we have, that it's unjust, but it doesn't need to be this way. And thanks for inviting me to this discussion. Again, I'm sorry I was late.
Thank you, Kiara. Now we invite Shiro.
Thanks so much, David. 2 reflections, and then I'll just quickly give some thanks and appreciation. It's very interesting that this conversation is taking us into, the focus is around the global economic governance architecture. And I think this is really relevant because as an institution that is committed to effective local governance, we actually got into the debt conversation because national level priorities or national interests are impeding effective local governance. When we start talking about global economic governance, we need again to balance the need for solidarity, which is essential, and then the inevitable asymmetries or the sovereignty questions. And that tension is coming out even here when we say, Kenya really did not need this facility. There are other African countries that would. And to say that Kenya will sign up, on account of the benefit to other countries, then really is not fair to the people of Kenya who are dealing with an economic governance crisis or deficit. So as we move forward, I think it's we need to be advised that we need to get into the global economic governance conversation and advocate for more just mechanisms and be more creative in advocating for alternatives. Like I said, Denise Namurete and her colleagues were advocating for a dove fund to counter the voucher funds, of course, that sometimes hide in these international lending facilities. So that's my first reflection. My second is that as an institution, this is extremely beneficial and enlightening, and we'll be looking at how we can take this forward because we noticed we didn't get a good presence from government. There were various reasons for some of the stakeholders who did not join. There are others who did not quite respond. I think when Tiara and Jason say, well, civil society will do, the reality is government has its agenda, and overseeing government has been a tall order, and we have a lot of, impunity. So the ability of civil society to hold government to account and force them to do this is what we're struggling with, and which is why we are saying this is a political problem. So given the reality, possibly we'll take a more advisory approach and really focus on some of the loopholes around this, as opposed to being very gung-ho, because our assessment of this is even if government does go for this facility without sealing the loopholes, it's likely to be violated. So that's our more likely measured approach, but we'll do a debrief and prepare something on that. So just quickly because we're out of time, just to use this opportunity to say a big, big thank you. Jason, your energy, your mastery of the subject, and this opportunity is much appreciated. And thank you so much for the opportunity for Okoa Uchumi to partner with AFRODAD, and I hope this is the beginning of many more conversations, because I think there are many other issues that have emerged that we need to unpack further. Thank you so much to Thierry and to Tiara for your wonderful inputs. Kwame, as always, thank you for making the time. You came in late from other commitments, but still very pointed in your interventions. David, thank you for always being there and really having our back and being able to guide us through this. And I think we begin to see that there's a wider scope of work around the kind of evidence we need to generate and the conversations we need to have to really unpack some of the problem areas that we've identified. Okoa Uchumi partners who are on the group, thank you for your continued solidarity. For Christine and the TISA team that have helped us do this, many, many thanks. And I hope this is the first of many conversations in the months to come. Thank you.
Jason, please go ahead. Thank you so much.
Thank you, David. Yeah, my first thanks is to Kiara and Wanjiro for the fantastic presentations this morning. I think they've really elucidated some of the key points, both at the national and global levels, and where we as AFRODAD, Eurodad, TISA, the Okoa Uchumi Coalition, need to find gravitating points to actually continue with the advocacy that we're doing. And also thank you to Kwame for making time to join us. And as usual, yeah, it's always a pleasure to take in those reflections. And to everybody who joined the call this morning. Monday mornings are not the easiest, so thank you all very much for making time to join us. And on behalf of my colleagues, Fidelite, Thierry from AFRODAD, this is something we had been planning since late last year, and it's really great that we've managed to bring it together. In terms of just concluding, a couple of points here with regard to the pandemic and the opportunity that it's presenting us. I think the first one is really, and I draw lessons from what Dr. Mukisa Kitui has been speaking about since late 2016, early 2017, about the soft underbelly of globalization. And this is what a pro-heavy neoliberal, open up your economy at every expense sort of crisis looks like, especially when you don't have the social safety net, the bank balances at your central bank to buffer against any type of economic shock. This is what we're witnessing in view of the COVID-19 pandemic. And I was very enlightened last week when I joined the CSW feminists workshop last week, and one of the speakers there mentioned that the pandemic has not accelerated anything. Actually, what it has done is exposed a lot of the weaknesses and the rottenness that exists in our current architecture, in the current philosophy and ideology that is governing or informing international development and national development at the same time. And so there is an opportunity here, as Chiara has talked about, for us to really rethink our national development agenda, how we approach it, the role of different agents, be it government, be it civil society, be it citizens, be it the private sector. Because what we have been exposed to really now, and we are witnessing it in the form of the vaccine nationalism that Kwame has mentioned, is also the profiteering from the indebtedness. Because what is essentially going to happen is the vaccines the prices are hiked up when they come and land on our continent. The money we pay is being paid for through debt relief, and that debt relief is then going back to the big pharmaceutical companies where we're buying the vaccines from. And I think it's important for us to think of how these different ecosystems are currently working, and why it is imperative to really challenge the status quo at this moment in time, and really come up with, through research, with strong advocacy, alternatives to the current systemic and systematic inequalities and power imbalances that exist when we're talking about global economy, global finance, and global debt and global trade. Because ultimately also, we cannot as a continent borrow our way out of this crisis. The quantitative easing that was mentioned a couple of moments ago. So there's a lot of work for us to do, but the fight still continues. We should not pander to the headlines for the sake of that, but continue with the fight, irrespective of the challenges. And very much, Wanjiru, the challenges that are being faced here in Kenya are exactly the same across the continent. So, aluta continua, as we keep saying, and we keep moving. Thank you all very much for this great morning, and have a nice day.
Thank you so much, Jason. Thank you, Shiro. Thank you, Chiara. Thank you, Kwame, and also thank you, Thierry, for those wonderful presentations that you made, and even the interjections that you were able to make during the meeting. I'd like to say that we have on the charts, you'll find the presentation as well as some additional information that has been shared there. And to also add my voice to thanking everybody, all the participants. I've seen the number just being constantly at 40. So I thank you so much for, sparing the time to be here with us. And adding to my voice to what literally everybody has said. This is just the start. The conversation is much broader, and certainly this topic is also a new topic for most of us. And so what we hope is that the outputs of this meeting, such as a brief or a meeting report, can sort of help us to break down some of the discussions. So again, thank you so much.
David,
the internet connection is a bit poor, but nonetheless, I think this is it. Thank you, everyone. See you all.